Art, would you take it away, please?
Definitely. Thank you so much, Jim and Tom, for your introduction. My name is Arik Vikri. I am a financial advisor and an accredited asset management specialist, and I specialize in helping clients with sustainable investing and long-term planning. And I want to thank you all for the opportunity to share some tips and some ways that you can use your money to align with your values, and of course, help with divesting from fossil fuels and other things that are impacting our environment. And also, you can also invest with some of your other assets. So I'll start sharing my screen and I'll give you a little bit about my background. All right, so I have been in banking and finance for 15 years. I worked for a large portion of that for a very large bank, and I can't believe I stayed there that long. I actually was a huge motivator for me to get involved in this space, as I was tired of some of the unethical behavior that I witnessed and was kind of tired of working with. And so I left the large firm and banking industry a little more than a year ago, and really wanted to focus my practice and my skills towards making a positive difference in the environment as well as my clients' lives, while with a more ethical and a sustainable approach. And so I started by doing a tremendous amount of research over the last few years on how to help clients align their investments and their dollars with their values, including climate change and fighting that. I will do this presentation will give you a little bit of a basics around sustainable investing, what it is, where it came from. I'll try to go over that fairly quickly so we can get into the meat of the presentation, where we talk more about how you can actually check your investments and search for investments that may divest from fossil fuels and invest in solutions to the climate change crisis, as well as along with your other values. Your other values are important as well, such as gender equality, firearms, whatever values you hold close and dear. We'll talk about how to search through your investments to see how you're invested currently and how you would like to invest in the future towards some of those initiatives, those sustainable initiatives. Okay. Let me get. All right. Number one, sustainable investing is an approach to investing that seeks to generate positive returns while also considering environmental, social, and ethical governance criteria. So that's the ESG that you hear quite often around these sustainable investing initiatives. And the sustainable part is the impact. The ESG is how they measure and report on companies' impact in those areas. So, some companies that want to be considered ESG and report on those issues, they'll have to report on their impacts and their initiatives towards making a difference in the E, the environmental, the S, the social, and the G, the ethical governance areas. And sustainable investing can help move capital towards companies that are making a positive impact in society, such as renewable energies and social justice initiatives, and away from companies and initiatives that are making a negative impact in those areas. A brief history of sustainable investing. It started with socially responsible investing in the 60s and 70s, which is mostly focused on tobacco and apartheid. But of course, today we've seen it evolve into a much more inclusive abilities, including those other criteria such as the environment, social justice, and ethical governance. And it's seen some significant traction in recent years. This is one example of an impact that sustainable investing has had in the markets and in the world around us, showing that we can make a difference by speaking with our dollars, as to say. In 1948, we saw a huge issue with South Africa under apartheid. There was a lot of human rights violations caused from that, and it was just a terrible time for a lot of people there. And throughout the 70s, 80s, and 90s, we saw a huge divestment from that country because of those horrific actions. And so the businesses in South Africa, 75% of them were financially struggling, and they finally negotiated for the dismantling of apartheid in 1994. And we think in large part due to, of course, these divestment from that company. So we saw that sustainable investing and speaking with your dollar can make big impacts in the world. We're seeing growing popularity. These numbers are from 2019. I didn't have any approved slides from more recent dates. I believe that the trend has continued upward in the last few years. 2022, I think, was flat or slightly negative. But for the most part, we're seeing more and more of the invested dollars go towards sustainable initiatives and ESG companies, which is a double-edged sword. We see some benefits where, because more money is being pumped into these areas, companies and in mutual funds and all of the investment opportunities are trying to capture more of that dollar, so they're becoming more competitive in those areas. So they're either trying to increase their impacts in these areas, they're trying to show that they're doing better in the sustainable sector, and then we're also seeing more transparency and more reporting around these areas, so we can actually make better decisions around these investments and what companies we want to support based on that data. The con to that is that we're seeing a lot of greenwashing. We're seeing these companies trying to say they're sustainable. They put up a big facade, and when in reality they're not making a positive impact, and they may even be doing things to make cause more harm, but they're slapping a green initiative on it to try to get through into these dollars. But I believe that we will still see some more competitive advantage as we put more money into this, because it will create more demand for transparency and reporting, which will help us kind of weed out that greenwashing. And I'll go into more of that preventing greenwashing later as well. As an investor, of course, we want to make a huge impact when it comes to using our dollars to divest from fossil fuels and from companies that are harming people in our communities, period. But we also want to make sure that we are comfortable with the investments we're making. And so it is, some people have the misinterpretation that they have to invest either very risky or very few companies, or they have to put all of their money into something that's going to generate less returns or be more risky, whatever the case is. But you can actually fall somewhere in this degree of impact and investment. On the left-hand side, you might just start by divesting from fossil fuels and keep the rest of your portfolio kind of traditional. And then, of course, all the way on the right, you may divest from fossil fuels and invest all your funds into solutions. But that might have its own risks and pros and cons involved. But you can, as an investor and consumer, can choose where you're comfortable landing in this degree of impact. The other thing that I hear from clients that are kind of concerned about investing sustainably is that they are going to get less returns based on their investing in these areas. And many studies are starting to come around that that's not true at all. And then in some cases, we're seeing greater returns for companies that are actually mitigating these risks, because that's, of course, to us, we're trying to make a positive difference, but to companies, they're mitigating risks. And when companies actually address these ESG issues, they tend to outperform their peers. You see a 2015 study from the Harvard School of Business, that found that companies with strong sustainability practices had higher stock prices and better financial performance than those without. And another example is a study by Morningstar, which we'll go over them a little bit more later, in 2020, that found that sustainable funds outperform their peers in non-sustainable areas, 10 out of 14 categories. So we are seeing good performance in these areas. And so you don't have to worry so much about having negative returns. Now, I think it is still where your performance may be different from the other traditional investing. A good example of that is that between 20 and 2022, we saw a rally in energy because of the prices that gas was charging for gas. So they saw good stock performance. And so, of course, initiatives where we're divesting from them during that period of time, you would see that your performance of your portfolio was not as good as the S&P 500, for example, that includes fossil fuels. So you may see a different performance, but of course, we know long-term, we're going to see impacts to the fossil fuel industry in a negative way. And your portfolio that's divested from that and invested in solutions will perform better. So when you take a look at the 5 to 10 year period of returns, that's where you start to see these companies performing well and better than their peers because they're mitigating those risks. Okay, and then this is some additional information about outperformance in the sustainable sector. These are, of course, 35% of funds found that they performed in the top 25% of their peers, and 66 finished in the top half. So we definitely are seeing a positive correlation with sustainable business practices and better financial performance. And these are some of the risks that you're avoiding by going sustainable in your sustainable portfolio. Companies with poor ESG performance, they're going to face legal, regulatory, or reputational risks because they aren't managing their environmental, their social, and their ethical governance factors. We see that all the time with, of course, the BP oil spill. We see that with companies that are having discrimination in the workplace. And then, of course, what we'll talk about a little bit more later is that the negative impacts of climate change on these companies will be a high risk to them down the road. And of course, on the contrary, is that companies with strong ESG performances are more likely to have sustainable business models that can weather economic downturns. So that because they're mitigating many of these risks, when we see some recessions and market downturns, these companies are better prepared for some of those market fluctuations. So now that we kind of got a brief history of investing, of sustainable investing, where it came from, and dispelling some of the myths, here are some tools for you to be able to search through your own portfolio, your own banking, all of your retirement accounts, and seeing where you land when it comes to sustainable investing. The number one resource, and one that I find most friendly for consumers to be able to search, is asyousow.org. It's a great resource for you to be able to check mutual funds, which is really the most common and popular investment for small consumers, because you'll see that majority of the time, you'll see that in 401ks, 403bs, retirement plans, and even just in your personal portfolio of taxable accounts. A large portion of consumers invest through mutual funds. And so this is a way for you to search that mutual fund and see if it's sustainable in that area. Now, this I'll go into a stock search tool next, but this is, in a couple more slides, but this goes over just mutual funds or ETFs. So exchange traded funds are also listed here. You can search ones that you already have. I recommend using the ticker symbol. That's the 3 to 5 digit alphanumeric number that's attached to your mutual fund, because many mutual funds have similar names, or they may have a family of funds. And if you don't use that actual ticker symbol, you may get a report that's not accurate to your portfolio or to your specific investments. So you would put in the ticker symbol here, and I'll show some results next. But you'll also notice in the lower left, if you are looking where to invest your money, there are actual search tools to find mutual funds that are fossil fuel free. They are free of deforestation, gender equality, gun-free funds. And there's actually a few more categories below this on funds that you can search for that are aligned with your values. And the way that you get here, if you go to asyousow.org, they have a landing page. You would actually click on the Our Work in the top center there, and there's the Invest Your Values under that tab, and it would bring you to this section. Here is an example. If you are to search for the top fossil fuel mutual funds, then this would be where you would land. And you can see there, it has a list of fund names. Unfortunately, I can't discuss specific investments, or it'd be considered a recommendation, which is a big no-no in my organization. Until I get to know you personally, I can't make those types of recommendations. But you would see a list of mutual fund names, their fossil fuel performance. That 0% shows that they have 0% invested in fossil fuels or fossil fuel finance. They have a separate fossil fuel rating there. That's another way some companies will say they're fossil fuel free, but they indirectly invest in fossil fuels through fossil fuel finance. And then fossil insurance is another way that they may be involved somehow with fossil fuels. And so this is a very complete website where they really give you a good idea of exactly where your money is going. You can also see the Clean 200. The As You Sow website actually put together a list of 200 companies that they consider a majority of their revenue is clean revenue. And so that shows a percentage of this mutual fund is invested in those 200 companies. Their total overall assets. If you have concerns about risk, if you're less risk tolerant, you'll probably want to search for net assets that are higher. Will give you maybe a little bit better performance and volatility. Of course, you'll want to take a full look at the fossil or the mutual fund goals to get more idea of that risk tolerance, but it does give you some information about that. And of course, their category, whether they're international, they're U.S. equity, they're small caps, which is the small businesses versus large businesses. You can kind of see more information of those here. So there's a lot of information to take in around these mutual funds and whether you want to invest in them or not. If you click on the category, there's a tab at the top here you may not be able to see. You can actually look at how that fund is performing in other ESG criteria. You can see some of these funds are performing really well in fossil fuels, but they may not be performing very well on gender equality. And if that's something very important to you, you can try to find a mutual fund that's performing well in both of those categories. But it gives you a more holistic idea of these mutual funds and how their money is being used. Get back into it. This is another resource for you to check mutual funds. This is the Morningstar website. And actually, you can even see in the top left or center left here, sustainable investing, there's a tab. But you can search those mutual funds, again, those ticker symbols or those mutual fund names in the upper left. And there's an example in the center of the screen here of a mutual fund that if you search it, it shows you the ESG risk. They give it a score. They give them the 5 globes if they're a sustainable company and they're doing well. And that number, that 17.90 is the risk that you're seeing. The higher the number, the higher ESG risk you have. And there's actually below this screen, Below this screen, there's actually written information about this company and how they came up with this rating. And so it'll tell you some of the good and the bad that the mutual fund company has done in order to get these ratings. And then you can also see that carbon area is going to give you specific fossil fuel ratings. And that'll be on the next slide here. You can see this is a popular index that people invest alongside of. The S&P 500 has almost 8.37% of the revenue generated from fossil fuels. And so if you have target date funds, if you have S&P 500 funds, they're primarily, this is normally how they're invested. And so if that doesn't align with your values, you may want to choose a different fund. Of course, it's going to have some additional information on other areas that this mutual fund is invested in. You can see at the top here, the clear bar is the actual fund. The colored in area is the category. So is it performing better or worse than the category in these areas? And then if there's, of course, any exclusions that are applied to these areas, and you can kind of see, get a good idea of where the money is and how it's being invested. Let me see here. This is where you can search stocks. So if you're interested in specific companies, if you want to search ABC Corporation, you can search their company name or their ticker symbol. And the lower portion here are the results. And it doesn't look like there's a lot of information here, but if you click on any of those plus signs, it gives you a tremendous amount of information about this company and what they're doing in these categories. What is the company's commitment to reduce its carbon emissions? What is the company's emission goals? How well is the company managing their ESG issues? Has the company been accused of controversial behavior? So their lawsuit history in these ESG areas. Is there any business activities that they're involved in that people want to avoid? And are they aligned with UN Sustainable Development Goals? And what's going on with this company. So this is a great way. The mutual funds are going to include hundreds of different companies and initiatives and investment security types. But if you want to search up a specific company you're invested in, or you just want to know more about that company, this MSCI website is going to be a great resource for you. Now, I will tell you, I think on the top of the screen, oh, that's missing. I could have swore that I put the full website address. But if you click on the Our Solutions tab, when you go to the MSCI website, there is a sustainable investing section. They have a mutual fund search engine as well. So you want to, if you're looking for the specific stocks, you want to actually open up that category. And then there you can find this stock search engine to search by specific companies. Another great resource for you. It's a little bit more advanced when it comes to the terminology it's using, so it's not as accessible, but it has a lot of great information, is carbontracker.org. This is a website for you to look at the overall themes of climate change and how it's going to impact financial markets. This website and its organizers came up with a concept of stranded assets. So they're tracking how companies and initiatives are going to be impacted by rising sea levels, the abandonment of fossil fuels, some of these changes that we'll see as we move towards a cleaner economy, hopefully, how these companies will be impacted, because the purpose of financial markets is to allow investors to make informed decisions. And this website feels that without including the impact of carbon impacts on the markets and climate change, investors aren't getting a complete picture of what they're investing in, the risks they're taking on by investing in those companies. So this website has a lot of information about how climate change and divesting from fossil fuels and into greener economy is going to impact the markets, and specific companies as well. They will actually list specific companies and their analysis of their stranded assets and how they're going to be impacted by a lot of these changes we're going to see. The next thing a lot of people would like to hear about is not only where they invest their money in their 401ks, their 403bs, their brokerage accounts, but where they keep their money in their bank accounts, their checking, savings accounts, CDs. There are a lot of good resources. I wish they were a little bit more universal. You may have a bank or a credit union that's performing well in these areas, and they don't show up on one of these websites as a sustainable bank. So I actually included a few of these websites, so you can kind of check those to see if your bank shows up on these areas. I know the bank that I bank at, I did a lot of research, and they're a green credit union, and they didn't show up on this website, but they showed up on another one. So you may want to check different websites to see if your bank shows up before you move your bank accounts, because they didn't show up on one account. But there's a lot of great resources here for you to search by area. Of course, many of the green institutions are online only, but there are local institutions as well. In New Mexico, I would say a handful. If you want to be very strict, you can find some local institutions that are avoiding fossil fuels. But bank.green is one of the resources. Bankforgood.org is another resource for you. And I will, or Jim and Tom will be sending out a copy of these slides to you after this presentation. So if you'd like to go through these websites after the meeting, they will be available to you. And of course, my email will also be available towards the end of this. And so if you want additional information or me to, send you some of these resources, I'd be happy to respond to any email questions as well. greenamerica.org/better banking is another resource for you to search for banks that are divested from fossil fuels. And other, they of course have a whole plethora of other ESG criteria that they take in consideration if you would like to align multiple values to your bank as well. Okay, so before I go over, this area is some general investing tips. I think one pitfall that I see consumers making when they're investing in the sustainable arena is they look up, a sustainable company and they put money in that. But that's a pretty risky endeavor just to invest in one company. So there's a few tips that I'll go over here on this slide. But one thing that I did want to cover is that for those of you that like to invest in bonds, you'll notice that I showed you websites to search for mutual funds and websites to search for stocks, but I didn't have a specific resource for bonds. And unfortunately, at this time, I've done a lot of research and there's really not a consumer-friendly search engine for bonds. Through the As You Sow website, you can search for green bond mutual funds, which gives you exposure to green bonds and sustainable bonds. But there's not a great resource for if you like to buy and hold bonds specifically. That is something you might have to contact a financial advisor to do a search for you and do some additional research. Or if you have a online trading brokerage account that you use, there might be some tools in that website to search for those green bonds, sustainable bonds, municipal bonds that invest in green infrastructure and renewable energy. But unfortunately, I didn't have a consumer-friendly search engine available for you. So I do recommend if you have, if that's something you're interested in, to contact a financial advisor or your institution and see if they have some additional resources to search that for you. All right. So the other thing, like I was just saying, you don't, even though you want to invest sustainably, you don't want to forget traditional investing guidelines. And there's some things that you want to do in order to make sure that your portfolio is performing with your risk tolerance, to make sure it's diversified so that you're not all in on one area, because if that one area is hit by some type of event, then your whole portfolio is affected. Asset allocation is another important thing. As you grow older, you might want to see more of your assets in bonds versus stocks or other types of investments that are considered less risky or less volatile. These are all considerations that you'll need to take into effect while you make your investment decisions. So that way you can not only invest sustainably, but you can invest along with your financial goals and your risk tolerance as well. So some terms for you to get familiar with is diversification. This is the act of ensuring that your money is spread across multiple sectors, multiple company types, different countries and areas. The more diversified your portfolio is, the less risks you're exposed to. Now, normally, when the entire market falls, or at least if there's a recession in the retirement market, you can't really avoid that risk. But you can diversify risks away from like business risk. If you're invested in one solar company, and it goes out of business, that's a huge risk. But if you invest in 100 different solar companies, the risk of one of them going out of business is much lower, of course. And it kind of it spreads out your risk in that area. Yes, Jim.
Yeah. So, Arik, you're talking a lot about risk and risk tolerance. Can you drill down just a little bit? How do I know what my risk tolerance is?
Thank you, Jim. That's a great question. Your risk tolerance has to do with, and usually the way that we find out as advisors is we ask you to choose on a scale of 1 to 100 is how comfortable are you with risk? And you may say something like 50. And then we normally look at a portfolio that's balanced, maybe a 50-50 in stocks and bonds, how it performed in the most recent recessions, such as 2008 or during the COVID crisis. And if your portfolio overnight reduced in value by 30 or 40%, how comfortable are you staying in the market? That is usually the measure of your risk tolerance. Because even though as a financial professional, I know when you're properly diversified and you're invested long-term, short-term market fluctuations, such as the 2008 crisis and COVID, most investments recover and make a profit after a 3 to 5 year time period. Some people really just can't handle that fluctuation. And that's if you're going to pull out of the market when your value is decreased by a certain amount, then, no matter how well that security is going to perform in the future, you realize that loss. And so it's, usually as a financial professional, it's my job to help you invest in a way that's going to help you sleep at night. If your portfolio's drops by 10% and you're comfortable with that, then we'll invest in something that should only drop by that amount, given historical performance. But if you're willing to take on more risk and you're okay with your balance fluctuating 30 or 40%, then we can take on additional risks to try to get a higher return because you're more comfortable with that volatility.
Thank you very much. Yeah.
Oh, yeah, no problem.
Yeah.
And this asset allocation kind of goes into that. And I mean, of course, we're seeing longevity risk. People are living much longer. So the old rule of taking your money out of stocks and putting it into bonds when you retire probably isn't going to work for most people anymore because they need their retirement to last 30 or 40 years into retirement. Hopefully, you can retire that early. But you may need to adjust your asset allocation based on your age and your risk tolerance. And that's something that you can, of course, talk to a financial professional about, but you can do your research on these terms as well through websites like Investopedia is a great resource to search up these terms and what they mean and how to apply it to your own investment portfolio if you're self-directing your own investments. But this is a great way for you to kind of not forget some traditional investing guidelines while you're investing sustainably so you can be successful in achieving your financial goals as well. And actually on the next slide, it goes into more detail on risk tolerance and what that means, and the risk that the investor is willing to take when it comes to investment performance. And we do see that the market, at least traditionally, is a risk return vehicle. So normally the higher amount of risk you're willing to take, the higher those companies and initiatives are going to pay you for that risk. But again, some people really just can't sleep with the idea of their money being high risk. So that's a personal choice for you on what that risk tolerance means to you. The other thing is time horizon. If you need to buy a house in a year, you may not want to invest in a volatile portfolio because even though, like I was talking about before, markets have traditionally recovered after crisis. It may take 3 to 5 years for you to get back to whole and start making a profit. And so these time horizons, if you need to make a large purchase in the near term, you may want to stick to maybe a cash or cash alternative, put in a savings account or a CD, something that we know you can access on a short-term basis to be able to pay for those large purchases. They may be paying less, which they historically have, but they will allow you to cover those large expenses that you might have coming up, such as retirement or a home purchase. If you'd like to learn more about this, there's actual courses you can take for free. So the USSIF is a website. You can actually go to their homepage. They have an education center and a list of courses. If you want to get really fancy, you can actually take a financial advisor course on this subject, but they do have a free course for consumers on how to be more aware of their investing. So you can actually go to this website. It's a 40-minute course that teaches you about sustainable investing. It has a lot of the same resources that I shared and a few more. I definitely recommend taking it if you're serious about sustainable investing, especially if you would like to self-direct your investments. Meaning making your own investment decisions. You're not having a financial advisor do it for you. I would recommend taking this course to make you better prepared for that. So your next steps would be to check your 401k, your IRA, your brokerage accounts, go to these websites, either through asyousow.org, Morningstar, the MSCI website that I shared, and check your portfolio and see how it's performing and if it's in alignment with your goals. Then you can make some changes to your investments to be in more alignment with your goals. I think my last tip on that is that, unfortunately, many 401k companies may not have a sustainable mutual fund option for you. If you've noticed on your 401k, they may have 10, 15, 20 different mutual fund options. And some of them, or all of them may not be sustainable. So asyousow.org actually has a 401k section, and it gives you tips on contacting your 401k provider and demanding that they offer sustainable funds. And hopefully we can all get together and kind of demand that change. The other thing is that if you have investments in a taxable account, such as a brokerage account, that means the investments are not in an IRA, they're not in a 401k. And so whenever you buy and sell in those taxable accounts, there may be tax consequences for those changes. And so that's something that you want to keep in mind. Even if you have a portfolio that you'd like to divest from fossil fuels and invest in solutions, you may not want to do it all at once because of the possible tax consequences. And so you can also contact a financial advisor such as myself or someone else. They can do an evaluation for you and tell you, how much taxes you'd have to pay, on capital gains and growth and stuff like that if you were to make changes to your portfolio. So that might be another thing to keep in mind as you're making these changes to a more sustainable portfolio. This process can be very complicated. Of course, you do not have to contact me for financial advice. You can contact any financial advisor, the one that you have or the one that you research. I would be happy to help you with some of these decisions. Even if you don't have a portfolio that you believe is large enough to invest, I could at least give you some advice on it. Even if you don't end up investing with me per se, I would be happy to give you some advice on if you're sustainable or not, if you need to make any changes and how you would do that. Even if you were to do it on your own, I'd be happy to give you that advice. But this can be a very complicated process. So if you have questions, please feel free to reach out to a specialist or myself. Okay. I'll come back to this screen. For regulatory purposes, I do have to at least show a disclosure around this presentation. There's a few things that you might want to read on the screen. It'll be provided in your PDF as well, but just some fun nighttime reading for you as a consumer. Okay, well, I'm ready for questions, of course, that I can try to answer. Unfortunately, I cannot tell you about specific companies or mutual funds because that would be construed as a recommendation, but I will try to answer any financial questions that you have.
Thanks, Eric. I'm looking at
Eric,
the
I have a
chat.
couple of quick questions. I'm going to jump
go
the
ahead.
queue for a minute.
Sure.
So maybe you have a rule of thumb. So I have, X number of dollars that in, let's say, a savings account or a CD or something, or I've got an IRA I can take the money out of because I'm turning 65. At what point would you suggest I need a financial advisor? What size portfolio range would you suggest I look for a financial advisor?
Well, many financial advisors may have a minimum. I know in the industry that I see, a lot of financial advisors will not take on clients that are going to invest less than 100,000. Some advisors may require a 250,000 or even a $500,000 investment before they will work with the client. Now, I myself, I would advise you on less than that. But it depends. I may not actually take on the account, depending on the balances. Robo advisors might be another option too for people that may have 5 to 10,000 and they want someone else to make the investment choice for them. There are a few. They're basically AI advisors that are sustainable out there. If you search for sustainable robo advisors or sustainable advisors, I'm sure you'll find a list of those. And those normally have a much lower entry point if you're okay with having a robot make some of these investment decisions. But for a person advisor, we see a lot of times it being around 100,000 to 250,000, depending on the advisor.
Okay, and then I have one other very quick question, and I don't mean to put you on the spot, but
Sure.
I'm going to. You said you work for a large financial institution. Would you share its initials with us?
Yeah, a WFB.
All right, thank you.
Yeah, I definitely, unfortunately, I learned a great deal of positive things from people that worked there. I had a lot of great experiences, but I could never really align my ethics and values with theirs. And so I'm happy. Once I left, especially, I could not believe how long I stayed.
Well, welcome to that you left the dark side. We're happy you're here.
Yes, me too.
Good. And I have a question for you, Eric.
Yeah, sure.
So I think a number of us have been watching the Inflation Reduction Act play out in across the nation with lots and lots, I think by some measures, possibly as much as $100 billion of announced new investments in clean energy manufacturing, new factories being announced, including a big one in southern Albuquerque at Mesa del Sol just a couple of weeks ago, which is great news in my mind. And I'm just wondering if you have a comment on how the Inflation Reduction Act has changed the clean energy investment landscape. And are there now companies in the clean energy transition that are growing, faster than before, or which sectors to look for? Just general comment on that question.
I think it's great. I think, of course, it is great. But when it comes to what that meant for the market is we're going to continue to see growth of investment in this area. It kind of was a turning point for a lot of institutions that I think have been considering getting into the green space, but they were worried about the future of finance in that area. How well would they be able to get grants and financing and, additional investments in that area? I think that huge investment from our government was a great green flag for a lot of these companies that are interested in getting involved, to let them know that they're going to see long-term financing and support in this area. And so it's not only going to see, of course, the benefits of government funding, but I think we'll see a lot of private funding and initiatives starting up because of this, because it was, kind of the signal for us all to get more involved, which if we didn't already need more, but some people, I think, and some institutions were waiting for something like that to happen. Before they got more involved. And Of course, I think with that initiative, we're going to see better support for the green energy when it comes to solar panels, tidal, all of those. Excuse me, my son is running around like crazy. We're going to see big investments in those areas. And so I think that we'll see increased financial performance from those companies. And so now is a great time to invest in those areas to get benefits from those changes.
Thank you. There, I'm looking at the chat. So couple of questions. I think an early on one, you were searching for the web URL, I think for MSCI, and William Baker said, is that msci.com? I think it is. I looked at that. It does look like the website you were showing. So if people are interested in looking that up, I believe it's msci.com. Correct me if I'm wrong.
Oh, let me see. This is Timothy going to ask, or maybe I can just answer. Yes, MSCI.com is the website. And it does take a little finagling to get there. You want to click on the tab for their work, then their sustainable investing. And they have two different search engines. One of them is for mutual funds. The other one is for stocks. And of course, choose the one that's right for you. Unfortunately, it's not all inclusive. I think that they have 3,000 or 4,000 different large companies. They may not have the startup company that you're looking for. They're expanding their reporting, but it is going to have most of the large companies that you hear, blue chip companies is what we call them, are going to be listed on that website and have some detailed reports.
Thank you. Let me read off one of these questions, and then I see we'll go to Beth, who has her hand up. Do you recommend certified financial planners, Eric? And are you one? Is there a role for CDs? And how can certificates of deposits be sustainable?
Well, I mean, that's going to depend on your risk tolerance, your time horizon, things of that nature. I mean, from a general standpoint, right now is a good time to get into CDs and bonds because of the rate environment. You can get CDs and bonds performing 5 or 6%, depending on the risk tolerance that you have, even in the bond market or CD market. So it is a good time if you are a CD or bond investor to get into that. And these rates aren't going to be long-term. Rates are cyclical. We see rates go from 0 to 6% and up and down usually every 5 to 10 years. And this rate cycle is anticipated to be shorter. We might see rates flatten out over 2024 or start to decrease. And then we'll stop, 2025 and on, we'll probably see rates, fall back down again. And so if you do like CDs and bonds, if that is part of your investment strategy, that is a good time. It is right now is a good time to get into some of those securities.
Okay. And do you recommend a certified financial planner?
Oh, yes. That depends on your needs. I think if you have a complex, business and estate and trust, and you have a tremendous amount of, tax strategies that you need considered, and you want long-term charitable giving demands, a CFP may be appropriate. And I think it kind of comes down to the specific advisor too. They may have a CFP, but them as an advisor, they may be overcharging, or they may not be offering all the services that they learned as a CFP. So the CFP designation definitely shows a dedication because it is a stringent requirement. You have to have a bachelor's degree, and you have to have 6,000 hours of experience, and there's a lot of things that go into getting a CFP. So it definitely is a very nice thing to have, and it does show that level of dedication and years of experience. But I do recommend that you find an advisor that you work well with, whether they have the CFP or not. And I don't have my CFP yet. I have the AAMS designation, the Accredited Asset Management Specialist, which is kind of on my way to CFP. But again, that might be something a difference too, is someone like me that is moving towards sustainable investments versus a CFP person that might have different beliefs and may not be as versed or focused on sustainable investing. So there's a few different variables to consider in that.
Thanks. Eric, and Beth has her hand up, so we're going to turn it over to Beth. If you want to activate your mic and ask your question, go ahead, Beth.
Thanks, Tom. I've got a multi-part question, 3 parts. New Mexico has had a green amendment to our Constitution since 1972. Please validate. Number 2 in this is how can we tell if there is greenwashing? What are the telltale signs to that? And the third part is Tesla. So my sense about Elon Musk is that he is totally an irresponsible actor, and I would never buy an automobile from him. But am I correct in this, or should I have more faith in this guy?
Well, yeah, actually, yeah, I can kind of try to tackle some of those things. Actually, when it comes to that green amendment in the Constitution, Jim had gone over it in the beginning. Looks like you're going to have a speaker series more in depth on that in September 25th, which I think will be a great thing. I would like to attend that. And they're going to talk more about that green amendment to our Constitution and what they're doing. It sounds like to uphold it and protect it, or implement it. And so I would actually refer back to Jim and that speaker to answer that question in more depth. When it comes to greenwashing, I think primarily it's using those third-party websites to vest those companies, because I think a majority of the time, greenwashing is mostly accomplished through their own marketing. So if you go to that company's website, they may have an ESG report kind of flashing in their home screen, or you may see an advertisement from them talking about their sustainability and their ESG performance and what they're doing to be, in those areas. But that's where you're going to see a lot of that greenwashing, is communications directly from those companies and initiatives. So it's important that if you're considering investing in a company, that if possible, is to search through those third-party websites, those third-party resources, to kind of fact check some of that data to see if it really is true, or if it's having the impact that they are describing. Sometimes they may do a very small thing and say they're making a huge impact in one of these areas, but when you fact check it through a third-party website such as You Sow or MSCI, that's not the whole story. So. Okay. That's what I would say is use a third party to check that information, and fact check that information and see if that's truly as green as they say.
Okay, great. Thanks. Yeah.
The last question, unfortunately, I can't make a specific recommendation towards Tesla itself. But what I would say is that my experience with some of these companies is that there are a lot of brilliant people working for the company. And the company as a whole may be doing some very positive things, and their CEOs are just kind of prancing around like crazy people. May not be the complete picture of that company. So, I wouldn't say you should or should not invest in Tesla, but you may want to try to look past the CEO, just because they do have a lot of weight and, of course, direction with the company, but it's not always the complete picture. So you might be able to learn more about what the company as a whole is doing when it comes to these ESG issues, their mission, and what they're trying to accomplish, and see if it's in alignment with your goals. And of course, that's still a risk. As a CEO, they can make some pretty big decisions for their company. So if those things still do not make you comfortable with that company because of their CEO, then there's plenty of other EV companies or solar companies or green companies you can invest in that might make you more comfortable. But that would be my word on that.
Okay, thanks, Arik.
No problem.
Great. There's a question in the chat, Eric, about your hourly rate, which I think I'm not going to have you answer verbally. If you want to privately message the questioner, Alex, you can go ahead and do that in the chat. But there is another question about Yieldco's. Fellow says, looking at the charts of two well-known ones, you can see they are massively volatile. Are there any that are in the volatility range of the Russell 2000? If so, how should I look for them?
You know, I have to say I'm not very versed in Yieldco. It's not, I've kind of done some dabbling in that area and it wasn't an interest to me. So unfortunately, I wouldn't be able to answer that question in depth. If you'd like to send me an email, I could do some additional research and give you a better opinion. But it's not an area I'm too versed in.
Okay. Thanks, Eric. Jim.
Yes, I think, Eric, I want to do a follow-up question to Beth's question, which is on the general topic of greenwashing. There's been quite an upheaval in greenwashing, the whole industry, which is carbon offsets. The last 6 months, it's really gone upside down. And so just real quickly, what we found is, what the investigative journalists have found is that the carbon offsets that a lot of people were claiming were not real, and without going into a lot of the details. So how up to date, I guess, are some of these websites, do you think, that you're recommending? Have they, I mean, it's really turned into quite a mess. Do you think they've had a chance to reevaluate things?
I would say websites like As You Sow would not include even carbon offsets. You know, when it comes to fossil fuels, they're looking for complete divestment. So I would think that they're fairly up to date. You know, I'm sure some companies, maybe they've changed their minds and decided to start dabbling in fossil fuels again. And it might take As You Sow, you know, a quarter, 3 to 6 months to kind of catch up with that. So I'm sure there is some variability. I think as an industry, we're still fighting for more transparency and more and better data when it comes to investing in these areas. You know, and of course, I even see it when I try to attend sustainable, you know, presentations for financial advisors. You know, we'll see these presentations hosted by fossil fuel companies and talking about what they're doing. And so that really disappoints me. But I would say As You Sow would probably still be pretty up to date when it comes to, because they're completely divesting from fossil fuels. And so even though people are kind of touting carbon offsets and you know, carbon capture, they're still avoiding that sector entirely. So I would still say that's a pretty good resource.
Great, thank you.
Yeah, and I did notice a couple questions. I was looking in the comments as well. I do definitely agree with Alex when it comes to the CDs. If you would like to invest in a green CD, just look up, of course, through those green bank websites to find those credit unions and banks. And if you buy CDs from them, you'll be, you know, it'll be considered a green CD. When it comes to the opinion of mutual funds that exclude fossil fuels versus ones that might be engaged in the more persuadable ones, I'm a little on the fence on this. You know, I've seen a lot of advocates say that divesting entirely may not be the complete answer. Some of these mutual funds, what they're claiming to do is that they're using their proxy voting power, which is basically when they own a certain amount of a company, they're able to go vote with their initiatives, and they're using their proxy voting power to basically strong arm these fossil companies to try to change. I would say that's kind of a 50-50 thing. I mean, they might be really making a difference, or they might just be putting more money in those fossil fuel companies' pockets. So it is kind of, I think that's a personal choice to you. If you believe that using the money to kind of try to convince the fossil fuel companies to change would work, then I would definitely say there are mutual fund companies out there that are ESG, and they're saying, hey, we're going to invest like 2 or 3% of this mutual fund in fossil fuel companies, and then use that percentage to try to make a change, and they're going to go vote at their board meetings to try to make a positive change. If you think that's going to work for you, I definitely support that. And of course, if you're of the mind that you just want to try to not give any money towards them, then a mutual fund that is completely divested might still be a better choice for you.
Okay. Jim, do you want to bring us home?
Yeah, I would just, Eric, I'd like to talk about a small anecdote on this last point. You said that people claim that they are going to, and maybe well-intentioned, going to use their voting power in this in the annual meeting to vote for a change or officers who agree with them or that kind of thing. So a few years ago, there's a large family foundation called the Rockefeller Fund. Maybe you're familiar with this. And the Rockefeller Fund still owns a large amount of stock in ExxonMobil, which of course is where their money came from. But they've gotten very progressive. The heirs to John D. Rockefeller are causing him to spin in his grave, because they are not in favor of the fossil fuel industry. And so they thought, well, we will use our considerable, and it's, I don't remember the percentage, but it was maybe 8% or something of ExxonMobil. It was, big. They threw up their hands after a while. It was not working. And so, that doesn't prove anything about the rest of everybody who's trying to do it, but it's a heavy lift to make your vote in an annual meeting count. So
yeah. And one thing for you to consider, if you would like to try a little bit of both. I mean, you have a bucket of money. You may use a portion of your money to either invest in a mutual fund that's promising to vote, or to invest in those companies directly and use your proxy voting power to make a difference. Use a portion of your portfolio to do that and divest the rest of it. You can kind of customize this journey to your own opinions and your own strategy.
This is great. Eric, I want to thank you so much for this evening. It's clear your experience and sophistication in this area is long and deep. I want to go back real quickly to one of the things you said in the opening, which was the history of this type of investing goes back to tobacco and to apartheid, the fight in South Africa. And when Nelson Mandela got out of prison and apartheid was overthrown, one of the first things that Mandela did was to thank the investment community for divesting from apartheid. That was immediately, and the investment community in the United States. So it can work. It can work. Now, that was a relatively small economy, but we do have among our powers as citizens here are investing wisely if we have some savings for retirement. So I want to thank you very much for helping us all understand more. And I want to thank Tom for his help tonight, and all our repeat viewers, and urge you to join us on September 25th for a discussion of how this new lawsuit, which hasn't got much press. We've heard a lot about the lawsuit, the kids in Montana. But we have a very important lawsuit, green lawsuit against the state in New Mexico, and we will talk about that in depth. Thank you, everyone.
Thank you, everyone.